Welcome back. You're watching Indian Open right here on Bloomberg Quint. Yes, the telltale signs in Interglobe Aviation and HCL Tech are the bigger draw, but deep within that, there are some standout pockets of outperformance as well. It was a turnaround quarter for Equitas Small Finance Bank. The lender reported a healthy growth in advances, robust traction in low-cost deposits. Headline asset quality too improved. To understand what worked for Equitas in the fourth quarter and whether they can emulate or better this performance in the quarters ahead, let's welcome in Mr. Raghavan HKN, President of Outreach and Inclusive Banking at Equitas Small Finance Bank. He joins us right now on the show. Good having you, Mr. Raghavan. Thanks so much for taking the time out. Arguably your strongest quarter since Q3 FY17. I mean, I look at the bottom line numbers, look at the GNPA numbers and tally them with what's happened in the previous few quarters. It's been the best performance in the last 5 or 6 quarters. What went right this time?
I think definitely this particular quarter was a standout. Predominantly, if you look at it, we didn't have the hangover of the provisions and NPAs in quarter 4. Because in quarter 3 we had provided completely for microfinance included portfolio, which was roughly around 140 crores and which was written off in the quarter 4. And thereby the NPA, GNPA numbers fell from 4.95 to 2.72. So if you split this into parts, if you look at it, microfinance, which was at 6.9, has fallen down to 0.72 in terms of GNPA numbers, and also non-microfinance, which was 4.11, has is down at 3.44. So overall, there has been a very good performance in terms of the GNP numbers, and which has resulted in a 35 odd crores of profits. And again, going back to the growths that you're talking about, till first half, we had the hangovers of the demonetization issues, especially impacting the microfinance business, and also the GST, which also kicked in. And we were roughly around 2% growth in the first half. Second half was extremely good. The markets picked up. The GST issues were behind us. Microfinance traction started picking up. If you look at the portfolio, which was falling down pretty sharply, has settled down in quarter 4. And as a business strategy, we wanted to also de-risk in terms of the one particular product, which was microfinance, which is now at 28%. And we exited March with almost 12% growth. So that was the kind of story.
Okay, so there were some one-offs in the MFI book as well, but just broadly, what is the vision of the management at Equitas? 12 months out, 18 months out, 24 months out, how will the mix between MFI and non-MFI change? Because your non-MFI performance this quarter on almost all parameters was quite exceptional.
We had, as a management, as outlining, it was very clear that we have a strategy of bringing down the microfinance portfolio to below 30%, which we have achieved now. And this year also saw introduction of 4 new products, which is non-microfinance products, which is starting from agri loan, business loan, MSE, and loan against gold. And all these 4 products have also had a very good traction and now contribute 15% to the total portfolio. And the non-MFI portfolio grew almost all with 52%. But if you look at the space at which we operate, it's completely informal sector. In the last 4 to 5 years, we have developed an expertise of assessing this completely an informal sector where you can't have a cash trail or a banking trail completely. So this has been the ability of non-microfinance products, ability to underwrite the informal sector. As you know, the informal sector is quite large, the penetration is pretty least. So going forward, we will leverage on our ability to assess the informal sector product, clients. And also it's important that we keep the product portfolio pretty good. The NPAs in this portfolio is roughly around 1.1%. So it looks like a huge opportunity, and growth should not be a problem at all because the opportunity exists and we have the ability to grow this particular sector.
But the mix would stay roughly 30-70, or would that be a change there 2 years out?
More or less it will stay around 30-70, and what that entails is that the microfinance will also have to grow. It's not that it will degrow, the microfinance will also grow, but that will grow roughly around say 30-35% plus, whereas the other products might definitely grow faster than the microfinance, so that the portfolio mix remains what we have planned for.
But in which case the book size or the book mix will change, right? If the other mix, which is 70% even currently, I mean, I believe your FY18 share in advances is down to 30% for the MFI book, if I'm not wrong. So if that piece is growing faster, wouldn't the overall mix change 2 years out?
Yeah, definitely overall mix will change, and in terms of microfinance, probably another 5 to 6%, there could be a dip in terms of contribution. But microfinance will also grow as a portfolio.
Okay. Fair. A couple of other questions on two parameters where you've scored well this quarter. I think the investors would want to know whether this is a one-off or will it continue and in what pace. Firstly, your cost-to-income ratio. I've spoken to a lot of investors who invested in your stock, and all of them say that at some point of time, there will be an inverted hockey stick impact on cost-to-income ratio, and the management will have to show that that in the print. You've shown that in the print this time around, wherein your cost-to-income ratio fell below specific levels, I think sub 77%. What's next over the next 12 months, cost-to-income?
Yeah, cost-to-income, if you look at Q4 was a first time where the cost-to-income ratio fell below 80, which is at 76%, right? And we have 392 liability branches, and those branches are completely operational. And if you look at the productivity of these branches, it is improving quarter by quarter, and which will have definitely a positive impact on cost of funds. So if you look at the growth in terms of the deposits, it's roughly around 25%, 27% quarter on quarter. So the productivity improvement in terms of branches is going to be there, and by and large, we are not planning large number of branches, new branches in the coming financial year. So hence the cost should be definitely under control, which ultimately have to bring down the cost of cost-to-income ratio in the coming quarters to see.
What levels do you envisage? Say the same time next year when we are having this conversation, do you reckon the numbers could be 300, 400, 500 basis points lower or even lower than that?
See, now the Q4, which is the quarter went by, it really showed a 4% decrease, and it would definitely come down for sure. We need to look at how much percentage. It's very difficult to speculate at this point of time.
What about the NPAs? You've shown a fair bit of improvement in the GNPAs, net NPAs as well. What are the targets for FY19?
Our target will be, definitely far lesser than what we have currently executed in this current, the previous financial year. GNPA numbers, it is at 2.72. One, the portfolio quality has definitely improved. Because of the economic activity, the repayments are also done extremely well. So hence, these two factors put together, and definitely the GNPA numbers will be far lesser than 2.72 for sure. It should be roughly around, we would expect it to be around 1.8 or 2%.
Okay, what about the cost of funds? I think the last time that I spoke to Mr. Vasudevan, if I'm not wrong, he was non-committal. I mean, while other companies have said that, oh, we have this fantastic book and fantastic rating, and therefore the rise in yields will not impact us. I think Mr. Vasudevan was categorical that yes, there will be an impact on cost of funds. What is the situation right now, and how will it shape up to your mind over the course of the next 12 months?
I think from a cost of funds perspective, quarter on quarter, the cost of funds have fallen. The cost of deposits that we are raising is around 6.5% as of now. And overall, put together, total borrowing cost is about 8.1%. And the raising cost of deposits might definitely push the cost of funds to some extent. To what extent we have to look at, because how we are able to manage the client deposits and plus the borrowing will only play out as to how much will impact our cost of borrowing.
Okay. We talk about how the Indian household, average household, the debt to GDP is so low compared to some of the other emerging markets, and therefore the room for growth is quite tremendous. My question to you is, to your mind, here on say 3 years out or say 5 years out, which is what the management would be thinking of. You wouldn't be thinking quarter to quarter, even though you talk to us quarter on quarter. What's the growth in the size of book that you envisage for you as a company, say 3 years, 5 years out, looking at the lending or the borrowing super cycle, if I can call it that India seems to have embarked upon?
One of the biggest strengths of Equitas is product assessment, underwriting of informal sector. We have built very clearly. And the other side, the opportunity in terms of empowerment sector, be it be a small size business, micro businesses are pretty huge. The NSSO survey of 2003 indicates about 51.5 million smaller ticket house, business units which require roughly around 2 lakh of ticket size. That's the kind of a requirement which spans out to about 12 lakh crore of an opportunity, right? That's pretty huge. And currently the penetration is 4%. While one side is a huge opportunity, the other side as an organization, we have developed the capability of delivering, growths in this particular, credit to this segment, which has to give us a consistent growth around about 35% plus year after year. So that should actually translate into the kind of portfolio that we are talking about. And challenge is that how do we keep this particular portfolio quality intact? It will be a challenge. But otherwise, next 5 years, definitely there's a huge opportunity for growth. And we are there in that space where very little competition is there. So hence, growth should not be a problem at all.
Sorry, just last question. And we have the other management on the line as well. But did I hear you say 30-35% growth year on year for the next 3, 4, 5 years?
Definitely, that should be possible.
That's the bare minimum, you reckon? There is a chance of this surprising on the upside as well?
Upside, definitely there is a chance, but at least we should look at 30-35% as growth.
Okay, you're being very cagey, Mr. Raghavan, or maybe, let's say, being very conservative or in at least your comments, but appreciate that. Maybe that's the nature of the business. Thank you so much for taking the time out. Congratulations on a good quarter and all the best for the year ahead.
Thank you. Thanks a lot.
Well, that's Equitas in conversation with us out here, fairly confident of almost all key ratios improving over the period of time. That stock marginally off in the session today, but has been holding out decently well over the last couple of trading sessions. What's done remarkably well, though, is Escorts. Not without reason. One of the leading tractor makers, they reported about a 26% growth in the April sales numbers. The question mark only is what's contributing to this growth, and what does Mr. Bharat Madan believe the outlook could be over the course of the next 3 months at least, or the next 6 months, considering that we have a forecast for a normal monsoon. He's the group's chief financial officer, needs no introduction, really joins us right now on the show. Mr. Madan, good having you and appreciate you taking the time out and speaking to us today. How would you sum up the month? It seemed all okay on the total sales front. Maybe, just maybe, a very small, tiny tune contributor, which is the exports bit, dipped a little bit.
I think overall sentiment continued to remain bullish on the rural side, though it's not really as strong as we saw in the last quarter. So last quarter industry grew almost 44%. So we're seeing some slowdown happening. So the industry growth is only about 18-19%. Though exports has grown about 28% total, including exports about 26%. So I think we'll look probably this quarter again, like you said, so probably will still show good double-digit growth. So overall, the sentiments continue to be good, and May normally has very good season months before the Kharif season starts. So we expect, I think, the growth rate will continue like this.
Did you take some inventory correction during the month, or were dispatches steady?
No, I think we had a steady retail also, so we didn't really have to do much to the inventory side. So we continue to be on the lower side of the inventory, the channel actually.
Commentary from across the staples community, Mr. Madan, for example, speaks of a fairly promising rural market recovery. We have the forecast for a normal monsoon. Would you want to revise the industry outlook for the next 3 months or maybe for the next 6 months?
Yes, so earlier expectation was that will be probably, for the full year we had indicated it will be probably a high single-digit growth. But now if the monsoon is really happens to be good, we expect, I think we'll again touch double-digit growth this year too, which will be, I think, the third continuous year of growth happening in this industry. But I think one thing which we must understand is the base has already gone very high. The industry has already touched a new peak last year with about 710,000 units. So I think it's a very high number which is already there. So that's why probably the growth will be slightly muted, but still can double-digit looks possibility now for the full year base.
Okay. What about the mix then, Mr. Madan? I mean, if indeed, because of the high base, the growth numbers, percentage numbers might not show enough growth, but would the mix change? Are customers moving to higher horsepower tractors, and will that improve realizations for you as a company?
Well, there's this swing happening, but it's very small in nature. So I think still the major industry continues to be in 30 to 50 HP range. It's almost 85 in the industry. So there's very small growth happening on 50 HP and above segment. So, but that as of now is only about 7-8% of the total industry. So it's not really a major game changer as far as the numbers are concerned. But the long-term trend continues to be towards higher HP. The 40 HP and above will probably continue to grow, which is the largest segment within the industry.
And within the same segments, have the price hikes been absorbed? Well, I'm guessing they are because the sales are looking okay. And would there be a need for further price hikes because of cost pressures or otherwise?
So probably that could be one reason why we saw some correction happening in April, because we also took one price increase in April because of higher increasing commodity prices. So we had to pass it on. So that could be one reason we see some temporarily some blip happening in the growth rate. But we expect, I think, that this will get absorbed in future, but it's all across the industry. So the prices are going up, so it's nothing new. So hopefully things will likely stabilize and maybe will look really good in the growth numbers for us.
Okay. One last question, Mr. Madan. Broadly, to get a perspective of what's happening across the country, are there specific pockets within the country which are showing a better response than others? What states, what territories are showing better growth than the others? If you can give us some light there.
But last year we've seen 3-4 states which didn't do well, and they ended up only with the single-digit growth. So states like Rajasthan, for example, in the north saw only small growth of about 7%. And then again, Gujarat was another state which had very low single-digit growth, about 4%. Then Andhra Pradesh, Karnataka, and Chhattisgarh. So these 4-5 states was in very slow rate of growth. But if you look at April again, barring MP, which is actually degrown in the market, otherwise all other markets are done in pan-India basis. Especially markets like Andhra, Tamil Nadu, it's done exceedingly well. It was almost 70-80%. So the growth continues to be, I think, good across all territories.
Okay, Ms. Madan, we'll leave it at that. But thank you so much for taking the time out and speaking with us today on Bloomberg Quint. Really appreciate your time.
Yeah.
That's the Group CFO of Escorts talking candidly. He's saying that the base is higher and therefore people should be careful when they forecast higher double-digit growth. He does believe that it's possible to revise the growth outlook from higher single digits to lower double digits. I think that's what he said. That's positive, but don't really think that, or don't really start building in a case for extremely high double-digit volume growth, because the base is a lot higher than what it was a couple of years ago. Okay, just before we wrap up the markets, let me talk about some green on the screen. Mid-cap IT is back in flavor again. L&T Info is up about 3%. Mindtree is up about 2.5%. Persistent is nearing 800. Wow, these are the levels from where it fell considerably when they issued the warning, and it's now back to 800. Just shows the tailwind in the space. Cyient is another one which is nudging another 2% uptake, and IT Tech, after a crash yesterday, is up about a couple of percentage points as well. What's not doing well? Hindustan Construction Company is 17% downtick, naturally on very, very high volumes. 20 million shares traded already. Indigo is down 14%. I would reckon this is the biggest fall that I've seen in Indigo in a really, really long time. We can give you the stats in moments from now, but this is the biggest fall in a few months that I've seen in Interglobe Aviation. And HCL Tech continues to grind lower. We were talking about 930 being a key support zone as per the technical charts. It's already at 937. And it doesn't look like the selling pressure is ebbing. If anything, it is trading at the lowest point of the day. So not a good sign. And two or three other stocks. Century Textiles, after a 10% downtick yesterday, is down another 6%. Jet Airways down another 5%. Biocon down about 4%. So there is pressure at the broader end of the spectrum, even though the headline numbers don't show too much of a correction. Very few stocks hitting the new high zone as well today. In fact, hardly anything which is worth a mention. So clearly, there is more pressure and more stocks on the downside as opposed to the upside. Not a very pleasant start to the trading day, I must admit. More of a continuation of what happened in trade yesterday. And that's why the FNO show will be able to throw more light on the liquid movers. It's a wrap on this leg of Indian Open, but stay tuned. And thanks so much for watching, of course. Stay tuned. The FNO show is up next.